Well, let's stay with the economy and this tension between the RBA and the government as to who should be doing the heavy lifting. Joining us live from Brisbane is John Quiggin, economics professor at the University of Queensland. John, it's great to have you on the show. Now, we are so interested in your take on whether these lowering of interest rates, and it looks like possibly quantitative easing around the corner, is the right way to solve the problem at the moment.
Well, I think in some sense it's proved irresistible. Australia is one of the last countries to have official rates fall towards zero. And when you look at what's going on in capital markets, the risk premium for equity, the difference between the average rate of return demanded by equity investors and the rate people are willing to take on secure assets like government bonds, that's been growing ever since the global financial crisis. So when you that implies both an increase in the market rate of return to equity, but also a decrease in the real bond rate over the long term. These have been long-standing puzzles for economists, but clearly that's the case. When you combine that with low inflation, interest rates are being pushed towards zero, regardless, in some sense, of the short-term needs for monetary policy. The problem is that leaves the central bank, the Reserve Bank, with very little option to use interest rates as a tool to stimulate the economy if that's needed. So obviously they're now having to look at quantitative easing, which is potentially problematic.
Well, as Adam was saying in his interview just now with the Finance Minister, certainly former Treasurer Peter Costello is very alarmed by this. He would say we're nothing like 2008 and the justification for QE is just not there.
Well, it's fair to say that we're not right now in the position of needing a big stimulus to the economy. But obviously, despite some positive news, the global economy is already slowing, and the risk of a quite sudden crash, I think, is more apparent than it was a year before the global financial crisis. Now, of course, that came more or less out of nowhere. I mean, we saw a few financial collapses leading up to it, but certainly we could be faced with such a shock. Clearly, as far as the cash rate goes, having 3 25 basis point cuts in the bank's armoury is not really going to protect us against a crisis should it come.
Just on that series of rate cuts there, John, the government obviously is very frustrated that the big four banks, at least, have only passed on half of the latest cut. They say that the rate is getting too close to zero and therefore it's getting harder and harder for them to pass on. Does that argument wash with you?
It's kind of unclear. It's striking that the margin remains so high after years of innovation that we're still paying the same percentage margin pretty much on home loans, even though, of course, the volume of the loans is typically much larger in real terms and despite a lot of technological advance. So that bank margin is a problem, but in a sense, I suppose the real issue isn't so much housing interest rates, although, of course, that's what's politically sensitive, but the whole structure of investment, the fact that we aren't seeing a big surge in private investment in response to these incredibly low interest rates at a global level.
Do you think that the government is right to ignore the growing calls for it to do more, so to speak, to stimulate the economy?
Well, certainly we're going to need, I think, to abandon the idea put forward by Senator Cormann that, look, we just leave all this stuff to the Reserve Bank. I mean, the fact is that clearly is a policy which didn't deliver the goods at the time of the global financial crisis, and now central banks around the world are finding themselves in a position where they really can't manage the economy because essentially we're stuck at or near zero interest rates for a more or less indefinite period. The government certainly shouldn't be doubling down on this notion of a surplus. I think what we'll see with any kind of slowdown, once the big tax cuts in 4 or 5 years' time come into the forward estimates, to maintain a credible commitment to a surplus, we'll have to have a policy that is excessively contractionary.
Yeah.
What we should be seeing in terms of a rational allocation, is governments taking advantage of these really low interest rates to engage in public infrastructure investment.
Yeah, it's really interesting, John, because we're seeing now this data coming out on unemployment in the US. Clearly, sort of record low unemployment, but no impact on inflation. You know, that sort of idea now economists are really questioning. Equally, we've got the financial stability report here, which is now the RBA is clearly worried about the rise in both the share market and indeed the bond market. So, as you say, politically, we've got here the government talking about borrowers and looking after borrowers, not the depositors that presumably voted them in. Do you think these tax cuts should be brought forward?
Well, of course, the tax cuts, the big bulk of the tax cuts being allocated to high-income earners probably wouldn't have much of a stimulatory effect. So if I were looking at tax policy as the fiscal stimulus and didn't face political constraints, I'll be redesigning those tax cuts to give more to lower and middle income earners who, according to the government's projections, will actually end up worse off over the course of the decade under the current projections.
John, just on the superannuation guarantee, of course, the government has just announced a review of the whole retirement system. I really wanted to hear your thoughts on whether it was a sensible policy to go from 9.5 to 12, given that we are in this era of such sluggish wage growth.
It certainly hasn't worked well with that high wage growth, and obviously the whole area is a mess with just with the treatment of pensions, the very favourable tax treatment of superannuation and so forth. So certainly a review is needed. It's very difficult, I think, to work out how to go. As the Irish proverb says, I wouldn't start from here if I was reviewing the superannuation scheme.
Right, and more broadly in terms of investment confidence, John, I mean, there are a lot of questions around whether there should be a bigger push on reform, whether that's in energy or indeed IR. These EBAs seem to be falling off.
Well, certainly, I mean, we've relied heavily on reform without really delivering, in particular, delivering substantial productivity growth. That was the big justification for reform in the 90s, was that we would see very sustained growth in multi-factor productivity, and that hasn't really happened. So I suppose we have to question whether continuing to try and juice up private investment is the answer, or whether we need to reverse the long-standing decline in public investment, as I say, taking advantage of these exceptionally low real and nominal interest rates that are available at very long terms.
Yeah.
So just on that topic, you're effectively saying that the federal government should be doing more on infrastructure. You know, of course, their claim is that they're doing more than they ever have, really, and that it's largely a state responsibility. How would you change the setup at the moment?
Well, again, I mean, the federal versus state thing is, I mean, a chronic feature of Australian politics, but clearly, the issue at a macro level isn't which level of government does it, but simply that it should be done.
Can I take issue with you on the reform agenda? You know, up till the 90s. I mean, didn't those productivity gains actually come as a result of reform on the industrial relations front? I mean, the problem now is that we haven't actually had a lot of reform.
Well, the reforms the productivity boost only lasted for 5 years or so. So we had a lot of reform after that, which was associated with low or negative productivity growth. The whole of national competition policy, the privatisation of Telstra, work choices for what it was worth, all of those things came in after the end of the productivity recovery. So and by, I suppose, about 2010, the whole of the gains of that period in the 90s had been cancelled out by below average productivity growth, and so which we've certainly continued. So measured productivity.
So just in terms of structural reform, it's certainly a phrase that I think we hear in this country more than any other country. I'm just wondering, what is the top structural reform that you would make if you could?
Well, I would be focusing on education, and rather than posing this as a choice between vocational and university education, as recent discussions had it, seeking to expand both, really trying to comprehensively increase the skill level of the incoming labour force, trying to encourage all school leavers to acquire post-school qualifications. That would be my number one.